Back in June, we were in a little bit in panic mode in the gilt market, and since then it's calmed down quite a bit. And inflation is falling in the UK. We saw that, and I think we've got 2 more inflation prints that come out before the next decision. So there actually is a lot of data that could come out to help sway that. It obviously is painful for first-time buyers, but there's so little housing stock in the UK. We've underbuilt for years, and that's what's holding demand up, and that's why it's only a 4% drop rather than more. And there's a lot of people in the UK that own their own homes outright, have fixed rates, and raising rates just doesn't feed through to the economy as quick as it used to. So my view is we probably actually shouldn't have any more rate hikes, because we need to recognize the economy is different today, and those rate hikes aren't going to have the impact that they want. You have to wait a lot longer to see it.
What does it also reflect about the health of the banks, right? Because a lot of those fixed rate loans are going to be going in for refinancing. And I wonder, given where rates are at this point in time, wouldn't that increase the risk on loan quality and delinquencies?
I think banks are going to be banks don't want to take people's houses. It's the last thing they want to do from a kind of risk, vulnerable customers, regulations perspective. And I think you'll see banks do everything they can to try to help people through it. When you look at where rates go, in some ways, rates were really low. There was a really competitive mortgage market. You almost might get banks refinancing at slightly better margins now that there's a bit more space and a bit more headroom in the interest rate margin. So it'll happen very slowly over the next few years. So I think it's not something we'll see as a big jolt in earnings. It's something that'll probably come through slowly.
I just want to pick up on the comment that banks don't want to take people's homes. They used to, right? They used to effectively close out mortgages when they saw that people were not paying back those loans at the right pace, if they just couldn't meet their mortgage commitments. That's changed in this crisis. There is a social aspect here. The other point is that banks haven't wanted to pay decent savings rates for a long time. That's also changed. So as we take a look at both sides of the book, the loan portfolio and the deposit side, where does it leave the profitability of banks in your view?
Well, I think banks have turned a bit into utilities in the past 5 to 10 years. They're not a sector that you should expect huge gains from. And I think you do need regulators and the government to recognize that they have to make some sort of profit to continue going. But I think what we need, more competition will help get better savings rates. You're seeing that with entrants like Chase coming into the UK and offering some of those higher rates. So you will have pressures, but there's also a lot to do on efficiency in terms of IT systems, incorporating better decision making, taking staff costs out. There's probably a lot they can do there to help keep the profit margins intact, maybe pay a bit better on those interest rates. And it's good news for savers. That often goes mixed. We talk a lot about mortgage borrowing. We don't really talk about the fact that people are getting more in their savings accounts as a good thing.
It does